Okay, in this video, I'm going to talk about DuPont analysis. So the basic idea behind the DuPont analysis is to break down return on assets and return on equity into component pieces to better understand what's driving the changes in the ratios. So let's take a look at return on assets. So return on assets is net income over assets. So as net income over assets, I can break that down into two other ratios or two other pieces that produce the net income over assets. So the first piece that we have here is net income over sales, which you should recognize as my net profit margin ratio. So this is my net profit margin. And then I multiply that times my sales over assets, which you should recognize as the total asset turnover ratio. So if I take my profit margin times my total asset turnover, that gives me my return on assets. So let's talk about this a little bit more. So I generally like a higher return on assets. And in prior videos, when I talked about the net profit margin, generally said I like higher, but I want to keep enough volume of sales. When I talked about total asset turnover, I said I like higher, but I need to make money on my sales. And this is kind of reflecting that. Basically, what we're saying here is with this formulation, that if I take my profit margin times my total asset turnover, it's what produces my return on assets. And here's some implications of that. If I can boost my profit margin, but if it comes at the expense of my total asset turnover, so in other words, I increase my profit margin, but my total asset turnover goes down, it's not real clear what the effect of my return on assets is. I may not actually be better off. On the other hand, if I could boost my profit margin and maybe even increase my total asset turnover, well, if both of those are going up, my return on assets is going to go up. So I have to look at sort of the interplay between those two things to see how that relates to my end result, which is the return on assets. And I'm hopefully going to get a higher number. So we're trying to see what is producing the changes. So another way of looking at this is we do the DuPont to investigate what is going on that's leading to that end result. So here's some ways that I could use this from an analysis standpoint. I could compare two businesses in the same industry side by side and see how they're doing. So here's how this could play out. What if I had two businesses in the same industry and they both had very similar return on asset figures, but then I do a DuPont analysis and I see that one company has a much higher profit margin and the other company has a much higher total asset turnover. So even though they are getting a similar return on asset outcome, they're getting there through very different means. And that may be very much related to the strategic choices of the firm and the target market and so forth. So for instance, the company that has the higher profit margin, maybe they are targeting a more niche segment with more specialized products that they can charge premium prices for. But as a result of that, they don't sell a huge volume. And so as a result, they have a high profit margin, but total asset turnover takes a hit. On the other hand, I could have another company that their approach is all about low cost, mass market. We just sell everybody at the lowest cost possible. So their profit margin is probably lower, but they may have a much higher total asset turnover. And so I could have two different businesses that get very similar return on asset figures, but due to very different business strategies, different approaches. And that's kind of one of the reasons why we look at the DuPont, is to kind of understand how did I get to this end result. Now, there's another way I could look at the DuPont. What if I looked at the DuPont over time? In other words, I look at, for a particular company, the DuPont analysis from one year to the next. And so if that's the case, and I look at how the return on assets changed from one year to the next, and I'm looking at the DuPont for one year relative to the DuPont for the next year, what I can see is what underlying pieces changed that led to that outcome. So for instance, let's say that return on assets went down, and I compare from year to year. Okay, well, maybe my profit margin was pretty much the same. Well, if that's the case, then pretty much what has to have occurred is my total asset turnover must have gone down in order to make my return on assets go down. That's the only mathematical way that really makes sense. So I can see that, well, hey, my profit margin held on, but my total asset turnover took a hit. Why is that? What happened? What led to this result? And that would lead to more insight into what was driving the drop in the return on assets. So here's another way of saying that. If I look at a graph of return on assets and I see changes along the graph of return on assets, any change I see on a return on assets graph should be traceable. In fact, it must be traceable to either the profit margin graph and changes going on there over time, or the total asset turnover graph and the changes there going on over time. And so one of the things that you can look at then is if return on assets is fluctuating, look at what kind of fluctuations have we seen in profit margin? What kind of fluctuations have I seen in total asset turnover? If there was a big fluctuation in profit margin one year and everything else is pretty stable, and then that flowed over to a big fluctuation return on assets, then it might make sense. Well, let's look at that. Let's look at that particular year where the profit margin had a big change, and let's see what happened. And maybe there was, a tax law change or an unusual one-time event situation or something else that led to that. And so that's where it should drive you to go back to the financial statements and say, well, let's look line by line. And if you get the financial statements from the Securities and Exchange Commission website, what you should generally see is a balance sheets and income statements that have multiple years next to each other. And so I can look, down the line, year by year, or for 2 years, say, and look line by line and kind of compare and see, what changed from one year to the next. If profit margin really took a nosedive one year, why? What caused it to drop? Did I have a big drop in revenue? Did I have a big spike in some expense somewhere? Which expense was it? Was it taxes? Was it interest? Was it something else? What led to it? And that's when you start seeing that if you're doing my ratio analysis and financial statement analysis really well, that it can lead to some really powerful insights about what's going on in the business and whether this is good or bad or not. But it often drives you to go back to the financial statements and look at what happened in there that led to this change. But the good news is the financial statements are there. So there really isn't much of a question for the most part about what caused a ratio to change. It's just a matter of looking back at the accounts on the financial statements to figure out, well, what changed. Now, there may be a question about, well, what caused that change, right? And that may be a bigger picture issue. But you should know, at least from the financial statements, you should be able to answer definitively, this line item is primarily what caused this, or a mixture of these items is what caused this change. You can go all the way back to the statements. And that's kind of the point behind the DuPont is let's look at what happened with the return on assets, but let's look at the pieces and better understand what's causing the shift. Because if I just wanted to look at net income over assets, just the overall return on assets, I would just calculate net income over assets. It'd be much easier. So the whole point behind the DuPont is let's look at the underlying components and let's see how they're shifting. And we can compare them over time for a company. We can compare them to other companies in the industry and see what that means. Now, that leads us to the basic DuPont return on equity. And basically everything I've talked about up to this point still applies, okay? And in fact, if you look at the basic DuPont return on equity, that first term here is the net income over sales, which is the same thing for the DuPont return on assets. The second term, same thing as the DuPont return on assets. So the only thing that's different is this third term, this assets over common equity. And that has a name, and that is the equity multiplier, okay? So it's looking at assets over common equity. Now, if I have a firm that has no preferred stock, then the equity multiplier can actually be related to one of the other ratios that I've talked about in a prior video, and that's the debt ratio. So if I express the debt ratio as in decimal form, so 70% would be 0.7, then the equity multiplier is 1 over 1 minus the debt ratio. So let me give you some examples. Let's work some simple examples here. Let's suppose a firm has a debt ratio of 50%. Well, in that denominator, I would have 1 minus 0.5. 1 minus 0.5 is 0.5. 1 divided by 0.5 is 2. So my equity multiplier is 2. So if a firm had a debt ratio of 50%, basically I'm going to have an equity multiplier of 2. And I'm going to take my return on assets, which is really what those first two things work out to, times 2. So basically, I'm going to multiply or magnify my return on assets by 2 to get my return on equity. So if my return on assets had been 10%, I would multiply by 2 to get a return on equity of 20%. Let's look at another example. What if my debt ratio is 75%? So 75% debt was used to finance the firm. 1 minus 0.75 is 0.25. 1 divided by 0.25 is going to give me 4. So now I'm going to have 4 here for my equity multiplier. So if my return on assets was 10, I'm going to multiply by 4 to get an even higher return on equity of 40%. Let's look at another example. What if my debt ratio was 90%? I financed my firm with 90% debt. So I'm going to take 1 minus 0.9. That's going to leave me with 0.1. 1 divided by 0.1 is 10. So now I'm going to take my 10% return on assets times this 10 equity multiplier. And now I'm going to have a return on equity of 100%. So let's think about what's happening here. So as I take on more debt, my equity multiplier is getting bigger. And as that gets bigger, I multiply my return on assets times a bigger number, and I get more and more and more return on equity. So does that mean that I should just take on a load of debt because it makes my return on equity bigger? Well, if you're thinking, well, there's got to be a catch here. You're right. There's a catch. So here's the catch. What if my net income is negative? What if I have a net loss? That's possible, right? So if I had a net loss, this net income would be negative, meaning I'd have a negative profit margin. So what if I had a negative 10% over here and I multiply that by a 10 equity multiplier, indicating a negative return on equity of negative 100%. Ooh. So here's kind of the takeaway. This equity multiplier is magnifying the results of the return assets, but it does so in either direction. So if you have a really good year in terms of return assets and you have a lot of debt, you're going to have a really, really good year in terms of return on equity. But if you have a bad year and you have a big equity multiplier, you're going to have a horrible year in terms of return on equity. So return on equity basically magnifies in either direction. It takes good results and makes them fantastic, and it makes bad results ugly, incredibly ugly. Okay. So the trade-off here is if I take on more debt, I potentially really boost or magnify my return on equity, but I've increased the risk that if things go a little bit wrong over here and I have a few bad years, it's going to be terrible. Hopefully that makes a little bit of sense. So that's where there's sort of a risk return trade-off here. If things go well with a bit more debt, I make all kinds of extra money, which is great. On the other hand, if things don't go so well, then things are just going to crater badly with a high equity multiplier, and that's going to be very bad. So that's something that you could look at. Now that brings me back to something that I mentioned in passing in a earlier video. And that was basically, it's possible in some cases to have a high return on equity for maybe a not so great reason. So sort of the right answer for the wrong reason. And here's why that's the case. What if I look at a company and the return on equity has increased from one year to the next? Well, the first thought would be, that's great. We increased return on equity. What's not to like? Well, what if we look a little deeper and we look at the DuPont and we realize that the profit margin is about the same, my total asset turnover is about the same across those 2 years. And the only reason the return on equity went up is because the equity multiplier went up. Well, that's a little bit more interesting. So if I evaluate the company and I conclude, you know what, the company had probably less debt than they should have before, I might think that the fact they took on more debt, which increased the equity multiplier, was okay. And therefore, the increase in the return on equity is okay. But that also means that I don't really expect this to happen again next year. I don't really think that upward shift is really a trend. It's more of a blip, basically because it's more of a one-time event kind of a situation, and not so much something that is a sustainable trend. So what that means then is you really do have to pay attention to how did I get to the higher return on equity. Generally, I like a high return on assets, right? So as long as it's looking sustainable, we're doing things that we can sustain, great. Return on equity, I like higher, but I primarily want it to be driven by return on assets. And in the long run, improvements in the return on equity, I want to be driven primarily by return on assets, as long as I have an appropriate equity multiplier. And it's not really the equity multiplier changing that is causing the boosts in the return on equity. I really want the return on equity to be going up primarily due to something with return on assets. And that's kind of the point of the DuPont, to take the end result of return on assets, return on equity, break them down into pieces so that you can understand what led to that result and analyze it more appropriately and determine, is it really something healthy that's going on here that's leading to this change? Okay, hopefully that's been helpful. Hopefully that makes sense. Thank you so much for watching and have a great day.